Hey everybody, this is the crypto group of the Public and Private Capital Markets May-term class with Rick Haskell. We're going to be doing introductions here. I'm Tom Creigh. I'm an economics major with a pre-law emphasis, and that's the URL to my LinkedIn there.
I'm Justin Shadley. I'm a recent graduate with a BA in economics and a minor in political science, and you can also find my LinkedIn in that URL.
Hi everyone, my name is Taylor Whistler. I'm an economics major and a data science minor at Westminster College. My LinkedIn account is shown.
Hello, my name is Jarrett Jordan, and I'm a finance major.
Hi, this is Justin Shadley. I'll be doing a portion of this presentation about Ethereum and the Ethereum cryptocurrency and what kind of is the future of cryptocurrency in this country. But before we can get into any of the specifics or the schematics of Ethereum, I think we have to have a brief history about it. So Ethereum was founded by a gentleman named Vitalik Buterin. He's a Canadian-Russian programmer who first heard about the concept of cryptocurrencies when he was 17. He then went on to found and help edit Bitcoin magazine, where he helped develop the ideas that would have later become Ethereum. But he was really drawn to the idea of the blockchain and the transformational nature of the blockchain and just the different tools at the disposal. So starting when he was 21, he started programming and creating Ethereum, which would later expand into the blockchain as we see it today. Unlike Bitcoin, however, he envisioned his project to have three components to it: a cryptocurrency, which is called Ether, smart contracts, and Ethereum virtual machine, which is another way of mining Ether. However, it's a little different. It uses something called gas, but a future colleague of mine will go into the specifics of that as well. Unlike Bitcoin as well, Vitalik wanted to make this a little bit more publicly sourced, removing even the centralizing factors behind Bitcoin. He wanted the list of founders, which is quite extensive, as you can see, to have a very engaged process throughout the entire development, which also expanded to the community of Bitcoin enthusiasts who later became Ethereum enthusiasts. And so the project was finally announced in totality at a North American Bitcoin conference in Miami in 2014. Continuing on, stating why he decided to found Ethereum and the motivating factors. As you can see, he has a big issue with the way that centralizing finance firms operate. He thinks that their power has exploited people, and so he wanted to make a project to help the little guy. Very, very, very motivational, very interesting. The developments behind Ethereum and the blockchain. And so it's critical at this juncture that we understand that the blockchain and the cryptocurrency are very similar and related to one another, but at the same time, they are not exactly the same. With that said, he primarily funded Ethereum via a crowdsourcing effort, which culminated in July 30th of 2015 with 72 million coins going live. These tokens, which were built off of the Ethereum blockchain, represented the base of Ether. Subsequent developments to both the blockchain and to the cryptocurrency have been titled Ice Age, Homestead, Tangerine Whistle, Spurious Dragon, Byzantium, Constantinople, Petersburg, Istanbul, Ural Glacier, and Berlin is the current operating one, with London being the next one. At the current juncture, there are just over 116 million Ether tokens in existence. On the left, you can see an example of Ethereum mining rig. So much like Bitcoin, the schematics are a little different, but they are mined online via the blockchain, which leads us to the conversation about pricing and just a bit of the schematics behind how all this has come into totality and fruition. That's a nice graph showing basically the trend line you see with prices jumping in 2017 and kind of leveling out. If this graph were to continue into the current juncture, which unfortunately CoinDesk does not have one, it would show another spike like that. Which brings us to the conversation about the hard fork incident. So the DAO was think of it kind of as a venture capital fund that was invested quite heavily in Ethereum an Ether primarily, and it had pooled the resources of a bunch of minor investors and Ethereum miners, but because of an exploit in the blockchain, in June of 2016, the DAO was hacked via this vulnerability, and 3.6 million Ether was stolen, which at the time was valued around 50 million. This led to potentially the closest that Ethereum's ever faced to being dissolved. With that said, that the founders acted quickly and rallied the community, in which they enacted a hard fork, which is an instance in a cryptocurrency or a blockchain when you kind of rewrite a bit of the software, and so that the mitigating factors and the risk posed by that hack were kind of undone. This caused a bit of a schism within the Ethereum community, with the current juncture of Ethereum as we know it continuing on, with a portion of the audience adopting something called Ethereum Classic. But for our purposes, think of this as basically the incident that almost destroyed Ethereum, but yet it all worked out in the end. This is an example graph of kind of a timeline of what happened. As you can see, just after the DAO, which is the July 20th was the final date of it, you can see the Ethereum Classic spurting off, while Ethereum, as we know it, continues on. And now we have to kind of talk about where it stands today before we go into any of the hardware and the schematics. But Ethereum today, like I said, just over 116 million tokens. Those tokens are valued about like 2,600 a token. London, the future update, has yet to be released, but Ethereum 2.0, a development sponsored by Bootkin, is coming out in the near future. Ethereum 2.0 is fundamentally going to change the way that Ethereum works. It's going to increase the transaction speed. So at the current moment, Ethereum is one of the fastest blockchains and cryptos when it comes to transaction speeds. But with this new update, it's going to get even faster. With that said, one of the more interesting developments that's come out of all of this is that a bunch of corporations, nonprofits, investors, hedge funds have pooled their resources together into something called the Ethereum Enterprise, the Enterprise Ethereum Alliance, which is a collection of over 150 of those organizations who continue to invest in Ethereum. This kind of gives it a bit of an institutional stability and acceptance factor. So as the money keeps pouring in, the coins gain in value and institutional trust, which proves that it is becoming more and more of a stable asset. With that said, there are still some questions about that, but my colleagues will get into that in the near future. On the left, you can see some of the firms and nonprofits and organizations that have invested into this alliance. Talking about transactions briefly, here's a rough graph provided by some of the just attainable data that shows how many transactions have been done in Ethereum. A truly incredible amount, which will only continue to skyrocket. With that said, I'll hand it over to my colleagues and let them continue with their portion of the presentation.
Hey everyone, this is Tom Creigh. I'm going to be taking over for Justin here for part 2 of our Ethereum presentation. So I'll be covering Ethereum as a viable market and some of the more nitty-gritty details about the program and about Ether, the cryptocurrency. So a general question that will be answered in this presentation is going to be, how can a program such as Ethereum be revolutionary as a digital market? So to start off, we need to have a little bit of a compare and contrast Ether versus Bitcoin. So Ether is the second most accepted cryptocurrency after Bitcoin. In terms of businesses who accept either or, Bitcoin's accepted by over 15,000 businesses worldwide, whereas Ether is pretty far behind at about 3,200 stores as of May of 2021. So a couple of reasons for this. Bitcoin is older than Ether. Ether was first offered in 2014. Bitcoin was several years before that. And another reason is that Ethereum as a system is much more complicated than Bitcoin is. So this requires a lot more testing to ensure financial safety. And because of those complications, there's a pretty significant learning curve with Ethereum, which we're going to get into a little bit later. So on this topic, who accepts Ether? As Justin pointed out, the Enterprise Ethereum Alliance is a group of over 500 companies worldwide who continually invest into Ether. A couple of these companies are names that you might know: Overstock, Gypsy Bee, and Shopify. A lot of travel companies as well. So as you see there, Cheap Air, Tripio, Travala, and Tripiki are all travel sites which accept Ether. Personally, I've only heard of Cheap Air, but the big brand names are gonna come along hopefully at some point. So as you can see in the picture there, that's a Banksy painting called "Love Is in the Air." This just in the beginning of May of 2021 was put on auction by Sotheby's. It sold. It was offered in either dollars, Bitcoin, or Ether, and I believe it sold in dollars. But just the idea that an auction house of this size would even accept payment in Ether is a pretty monumental occasion. So this is a map of international, well, of all the worldwide companies who accept Ether as payment. Something to note, zoomed out this far, this map is a little bit misleading. If you zoom in, you can see that the hot areas in the US and in Europe specifically, there's a lot more dark spots in there. It's not as widespread as this map might make you think. An interesting fact to note, in just in terms of highest density areas of companies accepting Ether, Estonia is #1 with 88 companies within the I believe it's the capital of Estonia, and #2 is LA in California. So this is the learning curve we discussed earlier. So issues with Ethereum, the learning curve. Vitalik Buterin, kind of the visionary and founder of Ethereum, he once said Bitcoin does one thing really well. It's basically like a pocket calculator, while Ethereum is more of like a smartphone with close to unlimited applications that you could develop and use on the program. So obviously, because of this, it's much more complicated. It's a blockchain with its own programming language. So this, if you don't understand the language, it's an isolator, and a lot of the consumer population doesn't. So this definitely, at the moment, limits the people who are interested in purchasing Ether and then using that Ether on Ethereum, the overarching program. So we'll get into how Ether is used on the program. It's used by developers to run applications on Ethereum. It can be traded on exchanges, as you can see on like Coinbase is probably the biggest in terms of exposure at the moment. And then, as we saw with the Enterprise Ethereum Alliance, it can be exchanged for goods or services from participating businesses. So Ether was designed as a way to fuel Ethereum. Basically, it's used to pay for the computational resources and the transaction fees, which is called gas, which are associated with Ethereum. So if you are a developer who's trying to run an app, you have to pay for that with gas to pay for the computational resources. And then if you post a smart contract, which is something we'll get into later, but it's basically what it sounds like. It's a contract. If you post one of those and then it goes through, then you have to pay gas as a transaction fee of that contract. So something that we need to spend some time on, just for clarity's sake. Miners and validators. Pretty much everybody's heard of Bitcoin mining. In Ether, at the moment, it's pretty similar to mining Bitcoin. Basically, what you do is you have a node, which in this case would be this mining rig that you can see on the image on the left, which this validates blocks of data and blocks of data and smart contracts. So it essentially just makes sure that the smart contract is completed to the satisfaction of both parties, and then as soon as it's validated, the funds associated with that contract can then be transferred to whichever party is expecting payment. So these are kind of the people that hold up Ethereum as a monetized program. If you didn't have validators, there would be no trust and the entire Ethereum economy would just sort of implode and fall apart. So as with Bitcoin, the mining process is something called proof of work, which is this process where the computer solves complex algorithms automatically. And upon completion of those and upon the validation of these blocks, the miner is then rewarded with a certain amount of ether. So that's kind of like the monetary gain and the incentive for someone to be a miner. So here we'll get into the smart contracts. So as I have said earlier, it's essentially what it sounds like. It's basically Ethereum's version of a legally binding contract that you might see in more traditional business transactions. So how they work is, as soon as it's agreed upon, there can be no deviation from the initial agreement. And this is ensured by the smart contract being uploaded to all members of the Ethereum network. So it's completely public. Anyone can see it if they want to. And then, as we said before, the miners will, using their mining rig, they validate this. And upon validation, the funds are then released to the party expecting funds. And this image on the left here is actually just a screenshot of the code of the smart contract, which, as you can see, it's programming. This goes back to the learning curve we discussed earlier. If you can't read code, and especially Solidity, which is the language being used here, you're not going to be able to make any sense of this at all, which is a big issue of why Ethereum maybe isn't as popular as it could be right now, just because of this issue of needing to understand a new language, basically. So, consumer hype or viable alternative? Ether was never designed as an alternative to domestic currencies in the same way that Bitcoin was. It was made to fuel Ethereum. It was essentially just created as a way to have a way to monetize transactions on the program and a way to incentivize people. So it incentivizes developers to create applications on Ethereum so that they can hopefully get some kind of a monetary return in the form of Ether. Or in the case of these smart contracts, where somebody might put up a smart contract to say, create a website for them. And so person A wants the website and person B responds saying, I can build that website for you for this amount of Ether. And then an example of this might be decentralized financial applications, which are a very interesting application that's been coming up on Ethereum recently, which are massively complicated on their own and for a topic for another day. That being said, as we saw with all these businesses that are accepting Ether as payment, there is always a chance that Ether could evolve into more of the role that Bitcoin was designed for. If a critical mass of businesses decide that they want to accept Ether as payment, then yeah, at that point it is more of a widespread currency, and it's just kind of evolved into that. So only time will really tell the role that Ether is going to play long term. So this has been pretty prevalent in the news lately with Tesla and Elon Musk coming out against Bitcoin, is the environmental impact of mining. So as with Bitcoin, Ether mining can have a large environmental footprint, given electricity costs, just general utilities, the amount of internet that you need to effectively run this. And the Ethereum communities actually acknowledge this, and similar to what Justin had been talking about with the hard fork, the communities kind of come together and are releasing an update called Ethereum 2.0, which he touched on a little bit, which basically the main point of this is the mining process is going to switch from something called proof of work to proof of stake. which according to Vitalik Buterin will reduce emissions by between 1,000 and 10,000 times, which is, massively impactful. So proof of work is basically the solving of complex algorithms that we touched on earlier. And proof of stake is essentially the miner will have to post basically a security deposit of 32 Ether before they can begin mining. And so essentially the miner is then blue checked once they post that deposit. And they don't have to solve these complex algorithms to prove that they've done the work. They just do the work, and then it's validated, and then it goes into the Ethereum network. So, and even as of right now, in the current Ether mining setting, Ether is a lot more efficient to mine as compared to Bitcoin, where it's about 10 to 15 seconds per Ether as compared to 10 minutes per Bitcoin. And this is only going to increase with Ethereum 2.0. So another thing we should touch on, because everyone's heard of NFTs, is the appeal of these. So NFTs are a part of the Ethereum platform. It's basically, you can think of it as the original file of a data file. For the most part, this has been digital artwork like Neon Cat, as you can see there. That's a pretty famous one. The awkward part about this is NFTs are digital files. These can be copied as many times as need be and with little to no effort whatsoever. A few sites that I've read have compared NFTs to owning like an original Monet print, where we can create a flawless copy of that Monet print pretty easily with today's technology. But that being said, it's perfectly inelastic supply. There's always only going to be the one original. And that's the same logic behind NFT. It's basically just digital art collecting. So NFTs are paid for primarily with Ether, because they're the Ethereum platform. And so with this inelastic supply, as we talked about, and the effect of future price expectations because of scarcity, as well as the increased nostalgia of folks who maybe Neon Cat was a big part of their childhood, and as they get older they place value on those nostalgic things. The price is only going to increase for some of these NFTs, which is why there's a market for them, and it's why we're seeing several pieces of artwork that are selling for several $1 million as pieces of digital art. So that is it for my presentation. TJ is going to be going up after me, and he's going to be presenting on Dogecoin.
Hi, I'm TJ, and I'll be talking about Dogecoin and how Dogecoin affects the cryptocurrency market. As you may have guessed, Dogecoin is a cryptocurrency just like Bitcoin and Ether. It was created as a joke in 2013 by two software engineers, Billy Marcus and Jackson Palmer. Dogecoin is a hard fork of Lucky Coin, which is a fork of Litecoin, which itself is a fork of Bitcoin. And a fork is when a blockchain or cryptocurrency is copied and either improved upon or made into a new cryptocurrency entirely. One of the key changes made was that Dogecoin has no cap on the amount that can be mined and released into circulation, making it inflationary. This has led to some controversy, which I'll get into later. Soon after it was released, Dogecoin's popularity skyrocketed, and it gained a significant online following. Then, in 2014, less than 1 year after its founding, Dogecoin enthusiasts raised about $30,000 worth of Dogecoin to send the Jamaican bobsled team to the Olympics. The creators of Dogecoin are clear that it was all a joke in response to the hype surrounding cryptocurrencies at the time, and never meant for it to become as serious as it did. In fact, they deliberately made it as undesirable as possible. Much to their surprise, though, Dogecoin took off and investors began taking it quite seriously. Marcus and Palmer weren't up to the challenge of maintaining Dogecoin, though, So in response to stress and toxicity within the community, they quit the project in 2015. Things cooled off for a while until the beginning of 2021, when a new interest was sparked in Dogecoin. The online community and various celebrities, including Elon Musk, began hyping up Dogecoin again, leading to a massive rally. At its peak, Dogecoin reached a market capacity of over $80 billion. Currently, Dogecoin sits at the 7th most valuable cryptocurrency, down from 4th place at its peak. So here's a chart showing Dogecoin's price from July 2020. Note that before this, there wasn't significant variation in its value since its creation. And here's a tweet by Billy Marcus claiming to have created Dogecoin in only 2 hours, making little consideration in the crypto's design. So how does Doge compare to the others? Varies in a few key areas. As I mentioned earlier, there is no limit on the number of coins that can be produced. Bitcoin has a hard ceiling, and while Ether has no predefined limit, Ethereum developers do have systems in place to control the supply of Ether entering the economy. Another key difference is the costs required to use the Dogecoin blockchain. Using a blockchain isn't free, and to incentivize miners to maintain the blockchain, they are given a reward paid by the user. For Dogecoin, the average fee is about 77 cents, which is much cheaper than Ether's 483 and Bitcoin's 723. One last key difference is security. Since the security of a cryptocurrency relies on the number of nodes maintaining its blockchain, larger cryptos will be more secure. Dogecoin, being less popular than both Bitcoin and Ethereum, is more susceptible to a 51% attack. And a 51% attack is where attackers, controlling 51% of the blockchain's nodes, are able to prevent and reverse transactions, effectively giving them complete control. And Dogecoin is controversial within the crypto community. Given its volatility and relative lack of security, financial experts warn that Dogecoin is a risky investment. Another concern is that since Dogecoin was and still can be considered a big joke, some believe that its success undermines cryptocurrency's utility as a legitimate currency. On the other hand, others are more lenient to Dogecoin's past and claim that Dogecoin's friendly community can help people get into cryptocurrency in the first place. And then even further on the fringe are those who believe Dogecoin is a truly remarkable cryptocurrency who will continue to grow and mature into the future of money. Regardless of your opinions on Dogecoin, it is undeniable that it is here to stay and will help shape the future of cryptocurrency. Up next, you will hear about our final thoughts about cryptocurrency and our determination on whether the cryptocurrency market is in a bubble.
Hello, this is Jarrett, and I will be talking about what type of market is Ethereum. They're looking at the investment opportunity and also the risk to determine if the asset class is a bubble, the effect of inflation, the result of normal functioning market, or the asset of having it come into its own. When looking at the investment opportunity of Ethereum, we see that it has the second largest market cap in cryptocurrency right below Bitcoin. And also it is more than just a cryptocurrency, but it is also used, it also could be used to process other types of financial transactions, execute smart contracts, and store data for third-party applications. And one uniqueness of the coin that many other coins don't have is that they're working on becoming more eco-friendly, because a lot of these coins in the production use a mass amount of energy from fossil fuels. And this is one reason that China has banned Bitcoin recently, is because of the amounts of energy that the fossil fuels release out. And they are one country that really is trying to be more eco-friendly due to all the pollution they have done in the past. When looking at the risk of Ethereum, we see that it is very volatile. The security is weak, technological bumps, and the future of government regulations. When looking at this chart of Ethereum price, of just their history of the whole coin, we can see that it is very high volatile, which could lead to significant losses in businesses, jobs, or even yourself if you're an angel investor, things due to that too. And that is very important too, because people like angel investors are using their own money to create more money, but also you have private equity owners that use leverage, that use other people's money to create a higher profit margin in the long run. But also this could be very risky in a high volatile market, because it could lead to significant amounts of loss of money. When looking at the security, we see that it is very weak and it's very easy to get into, and a lot of hackers have done in the past. And actually recently there's the most recent one, they've seen 2 to 5% of transactions on Ethereum were actually insufficient because of they just didn't connect with each other. And this is needed to do a transaction on the blockchain. When looking at the technological bumps, we see that they have issues in their area of the storing of information, not a cryptocurrency, but since the value of the coin has more value than just being a cryptocurrency, they are also seeing a rise of competitors in this area, which could lead to the price decreasing of the coin and its value to it. And also another bump that they have is that the transaction fees of Ethereum are very high. Looking at this chart, where 4,000 is, actually during that time, the transaction fee for a coin was $70. And that is one thing many investors dislike about it, that can lead to issues. When looking at government regulations in the future, we see things such as, for example, the one when I talked about it a little earlier, the regulation in China, how they banned Bitcoin recently because of the energy that is released from the fossil fuels and all the pollution it leads to. That could be one thing. And another thing is taxes on cryptocurrency. If they decide to put high taxes on cryptocurrency, it could also lead to a lot of investors taking out their money because of just all the high tax rates on it. Due to looking at the investment opportunity and risk, as a conclusion, me and my group have decided that it is a bubble market and that it is fairly new because it is new technology and new product that is fairly new, and this is usually caused rapid growth in areas over time. And I think later on that it'll become more of a market on its own, but right now it's still in a process of a bubble market.